Can you see it? Okay.
Yeah, we can see the deck.
Okay. Good morning, everyone. Financials, I know, are always a favorite topic, and we're going to be going through a few different aspects of financials today as they affect your business. One is just compliance related stuff. So what do you need to do on a day-to-day basis to manage your business when it comes to the numbers, and really how it affects the strategy of your business, and then the numbers that you can look at in terms of profitability and planning. This is just my introduction. So I wanted to just kind of go around and ask everyone, how do you feel about finance and accounting, just based on prior experience or when it comes to planning your business? You can type in the chat or speak up.
I guess I'll say something. I'm relatively intimidated by the idea. I'm pretty young. I'm only 20, but yeah, it seems like a lot. I don't know much about it, and that's where I think a lot of my that intimidating feeling comes from.
Yeah. And we can see comments in the chat. So it feels like a big task. It's always been intimidating. Yes, unfortunately, it is an essential part of your business managing its success and then dealing with the CRA and the compliance. But I can assure you that you can put everything down into a process and a practice that will help add a lot of value to your business and make sure you're getting the little things right so everything is fine in terms of legal, dealing with the CRA, dealing with any stakeholders. And you can put that process together. And I'm going to be walking you through different aspects of that. And then maybe I'll ask you at the end, and hopefully we're not feeling as intimidated. Okay, so I do have a word cloud. This is from the last session that I did. It's very much in line with what's been said here, but again, it sucks sometimes, but it is a necessary part. It's overwhelming. So why is record keeping so important? We can basically divide the needs into two different aspects. One is internal. So that is really for you as the leaders for your business, managing and answering questions like, is my profitability at the level? What should the pricing be? What are the legal requirements that I need to meet to operate? Do I have the proper controls and audits in place to meet external requirements, but also to make sure that your money, your assets, and your business is safeguarded properly? For budgeting, do you have enough money? What is the future potential of the business looks like, which gets into what we call forecasting. So the internal information really helps you to manage the business. And then second, it's also important to do the record keeping for accounting, because the CRA, of course, requires you to do your annual filings, whether it's HST, your income taxes, and they expect you to track all this stuff from the day that you decide you're starting a business and you spend your first dollar on it. There are other compliance needs, especially when you have investors get involved. They're going to want to see that you, if they're putting their money in, that you have proper safeguards in place to use that money appropriately, to use it strategically, and to show them that you have appropriate plans in place to get value out of that investment. That also applies to supporting organizations. So if you're getting a grant from someone, if you have suppliers, if you do a partnership with someone, they're going to want to know that they're partnering with the right people, and they can ask you for this information as well. And similar to investors, you can also you would also get extensive questions when you go to a bank and apply for a loan, or something, a company like BDC, something. They will ask you a lot of questions, a lot of history. So looking backwards as well as forwards to decide that you are your business is the right place for those funds. So that's the why. The other thing is that using finance. Sorry, let me just get rid of those. Finance helps to power your business. So from the internal perspective, when you're running your business, you're going back and forth between managing the day-to-day and doing the strategic planning. So, if you're launching a new product, when does that happen? How are you sourcing supplies? So managing all those strategic decisions on, let's say, a monthly basis, quarterly basis, But going back and forth between just the day-to-day and the strategy, you need to have a process in place where you're looking at the record keeping and reviewing the performance of your business when you run it day to day. And that feeds into your strategic planning. So we're looking at a cyclical process. You run your business, you do the record keeping and review, that feeds into your strategic plan. You update your budget, you consider, is it costing me too much? Do I need to update my price? All of those strategic planning questions would be answered by the review that you do from running your business. And that strategic planning that then feeds into your budget. So when you're looking forward, how is your business going to perform? And you use that budget as a guide to run your business. And then eventually you would be comparing your performance to that budget. So having that cycle instead of just kind of going back and forth is very, very important. And that's how the numbers actually help you to power your business for better, and you get much better value from your business, and so do your investors and stakeholders. So the process of financial just record keeping and accounting helps you transform this into proper financial statements, user reports. Can anybody name any financial statements for me?
A receipt?
Yep. Any other financial documents or statements that you can name?
An invoice,
Mm-hmm.
tax return,
Yeah. Anyone else? And then all of these are summarized into 3 key statements. Okay, so the 3 key statements, I will walk you through them, and then we'll touch on some of the statements that you have brought up within those. I'll show you where they come. So the 3 statements that go into the key financial reports are called balance sheet, income statement, and cash flow. We're going to first look at the balance sheet, and what that essentially is a snapshot. So it's like you take a picture and it's frozen in that moment, whatever you see. And that's what the balance sheet shows you. What is in your business as at that moment? This is usually done by, at the end of the month and end of the year. So key dates, probably like December 31st or March 31st for your business to do an annual check. And then quarterly would be end March, end June, end September, and December for you to also take a look at this. And there are 3 key components to a balance sheet. First is the assets. So everything your business has in possession, and that's being used by the company as of that date. And the equation on the other side of that is liabilities plus owner's equity. What that means is everything that is in your business, either you own it or you've borrowed it from somebody to use it within your business. And assets equals everything you own plus everything that you've borrowed for somebody from use. Does anybody have any questions about the equation? And then I'll dive into the examples within all 3. Feel free to stop me at any time if anyone has questions, type in the chat or just prompt me. I think it works best that way because it's just a lot of information coming at you. Okay. So under assets, you see cash, of course, accounts receivable. So if anybody owes you money, you can reflect that as your asset that you're waiting to collect that. If you put short-term investments or long-term investments, for example, you have some extra money, you put it into a GIC, that would be an asset of the business. If you made any prepayments, so let's say you've put a deposit down on some supplies that you're waiting to get, that is also an asset. Any inventory that your company owns, so it is, let's say you get raw materials and then you're transforming that into a product. Until you transform that into a product and sell it, for the time that you own it, it's an asset on your balance sheet. Those are what are called current assets. So they're assets that have a very short lifetime within your business and they keep cycling. So cash, you're spending it, collecting it, spending it. It has a short lifetime. Same with inventory, you're cycling it out of your business pretty quickly. The threshold is usually 1 year. So if it's something that can be turned into cash or sold within 1 year, we call that a current asset or a short-term asset. And then long-term assets are ones that you expect to hold for a much longer time. And they're usually, it's like equipment, a factory, a building that, it's going to last you for 10 years, 20 years and serve your business. Investments can also go in that category if you're putting money into something for the long term. That's it for assets. If anybody has any questions, just stop me, but I will jump into the liabilities. So liabilities is anything borrowed. Again, that also goes into the category of current or non-current. So current liabilities are anything that you expect to pay within 1 year, and non-current liabilities are anything that you don't have to pay back within that 1 year time. You'll have more. So, for example, if you get a big bank loan, or if you get a mortgage, you're looking at 20 years, 30 years. So that would be long-term or non-current. Current liabilities.
Sorry, I just had a quick question.
Yep.
For your assets, does that include any possible future assets that you might be that you're going to invest in? Say that you needed, say if you couldn't afford a tool that you needed.
Okay. So if you need a tool, let's say you're planning on purchasing it in the future, currently you would probably be reflecting it as, let's say you have cash set aside or you have an investment set aside and you're going to buy it in the future. So when you buy that asset, let's say you buy it on January 5th, as of December 31st, it would not be reflected on your balance sheet. The day you buy it is the day you add it onto your assets.
Okay, so everything is in current time, essentially. Okay.
Yeah. And it changes over time. So the day you buy it, the day you own it, and there's specific criteria on, as you would be familiar from a legal perspective as well, what day you officially own that item, and that's the day you would be able to list it on your balance sheet. Okay, so for liabilities, the one most common liability you would be dealing with is accounts payable. So let's say you buy raw materials for your product or to generate your service from a supplier, but they give you 30-day terms. So you buy today, you can pay them in 30 days, you owe them that money. So you would reflect it until it's paid, you would reflect it there as a liability. Then you have loans, which can be short-term or long-term, and you just identify them separately based on whether they're due in less than 1 year or more than 1 year. You also have income taxes due is a pretty easy one. There's a few more, I guess, complex concepts. So if you've accrued interest on a loan, let's say on December 31st, you were supposed to pay interest, but you haven't paid it, or you declare dividends for your owners. If you haven't paid those items to your shareholders or investors, but you promised them as of any given date, as soon as you promised them that, you would record it in your liability. So basically, you're holding money that doesn't belong to you because of that promise, and you're expecting to pay it out. So you would record that as a liability. Similarly, deferred revenue is when a customer buys from you and you've promised to deliver the product or service to them, but you haven't done it yet. So let's say somebody pays you in December to send a batch of products over to them, but you don't ship it out until January. If you look at your balance sheet snapshot as of December 31st, you would show that you've received the money, but you have that pending obligation to your client to deliver to them products that they've paid for. And then non-current is also loans and debt. If you have big investors, that would go under long-term debt. Any questions about liabilities? Owner's equity. So owner's equity is when you have assets and you take out the liabilities from that tells you what portion of the assets are under your ownership, or whoever might be the owner of the company. One disclaimer to keep in mind, this is an accounting calculation. This is not indicative of what you might actually be able to sell your company for. Let's say, you're selling all your shares, your ownership, the market value or the value somebody assesses for your company and decides to pay for it will not match this, because a balance sheet cannot show value for things like, how committed your customers are to buying regularly from you, how valuable the ideas in your business is, how much cash, let's say you have an IP, how much cash that can actually generate for you because you have that unique value proposition. Accounting doesn't really show that. So this is just a number that you report, and your stakeholders that are looking at it understand that it's an accounting number. So owner's equity is basically a representation of the accounting value for your common shares and anyone else who holds common shares in the entity. Yeah, and then retained earnings. So retained earnings is used to basically balance, making sure that the equation works. Every year, your owner's equity is changed by the amount that you have as an income or loss. So, sorry, let me break this down a bit. Your owner's equity starts with, let's say you put $10,000 into the business as cash. That would be your starting owner's equity. In the first year, let's say you make a loss of $1,000, you subtract that, and then your owner's equity would be $9,000. The next year, if you make $2,000 income, then your owner's equity would jump up to be $11,000. So it keeps accumulating. And the other thing you deduct from owner's equity, if there's any payouts done to you, which are either, if you pull out part of your equity, so it's taking out of that $10,000 investment, let's say, or if you pay dividends, which is a return that you can issue to your owners as a payout, similar to interest on loans, and that would also come out of your owner's equity. That's it on the balance sheet. We're going to be looking at the income statement next. If you have any questions, just stop me. So the income statement, this is a snapshot for a given period, and the period can be different depending on your needs. So if you as a founder are used to a practice of looking at it quarterly, you would make an income statement for that quarterly period. The most common practice for documentation is that you maintain annual income statements. So when you produce your balance sheet for December 31st every year, you would produce an income statement covering January 1st to December 31st, that whole 1 year time period. And that would be what the CRA looks at. That's what your investors and let's say you go for a bank loan, they will ask you for your annual financial statements for this period. So the income statement, it starts with revenue, which is all the money you've collected from the sale of any products and services that you have. From that revenue, you subtract what are called direct costs. Direct costs are anything that goes specifically into the production of your product and services. So the raw material, if you're making a car, the wheels that go into it, the metal that goes into it, that everything that goes into the product would be accounted for in that. If, let's say, you are a consultant, that would be the compensation for your time, as well as any other supplies. Let's say you require office supplies to keep your practice going, to deliver whatever you need to your clients. Maybe you mail them some documents. That would all be direct costs because it's related to you delivering that service. Revenue minus direct costs give you what's called your gross profit. This is a very important number to look at when you do your pricing and forecasting. Even in the short term, you're looking for this to be positive. Because if you cannot make a positive return from just the specific input, specific direct costs that are going into the production of your products and services, that's going to be very, very difficult to fix in the long term. then if you look at the next line, which is indirect costs are generally higher when you're starting out a business, but in the long term, they decrease, and you can learn to manage them better. So if your operating income, which is revenue minus direct costs minus indirect costs, they might generally be negative. Your operating income might be negative in the short run. That's okay, but you're really looking for your gross profit to be positive. Just as a general practice. So revenue minus direct costs minus indirect costs. So just a couple of examples of indirect cost is, let's say as a founder, you're doing all the time that you spend in terms of managing the company, accounting costs, legal costs, the cost of maintaining an office. Those would all be indirect costs that are necessary for the business, but they're not necessary for you to be able to produce and deliver on the products and services. And then the third type of cost that you have is finance costs. And those are basically interest on loans. If you get any kind of financing, the costs related to that you have to pay. So it's strictly related to, bringing in money for your business. What does that cost you, and not of actually managing the business. And when you subtract out finance costs, that gives you your number, which is called net income before taxes. Then you subtract out your taxes, which are, if you have a net income before taxes, you're going to be paying tax on it. If you have a loss, then you will not be paying taxes on it. You would have, for tax purposes, you would have a benefit that you can apply your loss against next year's income. So that would be a benefit that you can record. And then once you subtract out that tax effect, you get what's called net income. Any questions on this? I know that was a lot of information. We're going to be diving a bit deeper into the different types of costs when we look at the budget as well. But if you have any questions for now on this, good. Okay. The third type of statement that you produce is called the cash flow statement. It's very, very similar to the income statement. It's produced for a different purpose. So it has a few key differences. So similar to an income statement, it's done over a period of time. So that might be, January 1st to December 31st that you're required to produce the annual statement, but you could look at it quarterly, monthly. It's very useful for internal tracking as well. There are three types of cash flows that are shown within the cash flow statement. So it's basically taking the information in the income statement and it's reallocating it into three buckets. Those three buckets are called operating, investing, and financing. So operating is the one that includes most of the items. So that's going to include all your direct costs, indirect costs, except it's not going to include ones that are non-cash. So non-cash items includes things like depreciation, and it would reflect the fact, let's say you bought raw materials from your vendor, but you haven't paid for it yet. The cash flow would only reflect the amount that you're paid for, but the income statement would reflect the amounts that you've actually used. So it doesn't necessarily align in terms of timing. And when you have an official accounting system that can track inventory, that can track receipts, this is something that accounting system would be able to keep track of. The other thing that operating cash flows don't include is what's called depreciation. So for accounting purposes, one of the special entries that you do is every time you buy the long-term equipment, when you have your long-term assets, so let's say you bought equipment today for $10,000, you would not put it in your income statement today and expense the entire $10,000. You expense it over time. So if you expect that $10,000 to last you, let's say the equipment has a useful life of 5 years, every year, let's say CRA lets you take $2,000 out of your income to categorize that as an expense and give you the tax benefit of that spending. So you would take out $2,000 out of direct costs for equipment that you're using to produce your product. But from a cash flow perspective, that's not real cash coming through. It's an accounting entry to have that $2,000 per year. So that does not get reflected in your operating cash flow. And that would be a difference between the income statement and the cash flow. Instead, what you have is the cash flow shows separately all the money that you're putting into investments. So all the money you're putting into what's called capital expenditure, purchase of assets that last you for a long time and help you generate revenue, and any investments that you're doing otherwise. So that equipment in the cash flow would be listed as $10,000 in the first year that you spend it. And this is more realistic because it's going to help you to see that you're running out of cash, or what is it that you're using your cash on. It shows you the reality of cash flow for businesses. For example, you're starting out now. In the first couple of years, you're going to have more investing cash flows because you're setting up your business, you're setting up the operations to produce the products and services. And over time, that investing cash flow would drop off. So that's the key difference between operating for cash flows versus an income statement. And then investing is anything that you spend on in the long term to improve the capacity of your business, to set it up to operate. And then the third category we have is financing. So financing reflects the money you're bringing in. This is something that's not reflected on the income statement. So let's say you sell shares to someone, whatever price they pay you for those would be reflected here. If a bank gives you a loan, or you get debt from another source, or let's say you get a grant, that would all be reflected here as money coming into your business. Here, you would also reflect if you have debt when you pay it back, if you pay any dividends and interest to your shareholders or debt holders, that would all be reflecting here. And that's because it's a financing expense. It's not a true cost of actually just operating your business and producing the product or service that you're selling. And then at the bottom, all three of these, so operating cash flow plus investing cash flow plus financing cash flow, tells you what is your total change in cash over a period of time, whatever period of time that you're looking at. Let's say for the 1 year, and that should match your balance sheet. So let's say your cash at the start of the year was $2,000, and at the end it's $10,000. This change in cash should reflect that, increase in $8,000, and you would be able to analyze what that cash was generated from. One thing to keep in mind with the cash flow, negative and positive is not always an indicator of good or bad. It tells the story of basically what's happening in your business. And it really depends on how you explain what stage your business is at. And then you would interpret the numbers as good or bad. So let's say if you've had, if a bank is looking to give you a loan and they look at your cash flow for the last 2 years, your investing cash flow is very high. But you can explain it to them that, I spent money on XYZ because it was increasing the potential of my business. The demand for the customers was there. I needed to produce more products. So you can explain that to them, why you had high investing cash flows. Similar to operating, if you would be looking at a trend, operating cash flow in the long term should be positive, because that indicates that there is capacity in your money to perform well. But if you have periods where you've had to invest more upfront in direct costs, it might fluctuate. So let's say if you pay suppliers to buy raw materials in bulk, you would have higher costs in certain periods rather than others, and you can explain it that way. Any questions? Those are the three statements. So balance sheet, cash flow, balance sheet, income statement, and cash flow. And then the next section we're going to be diving into is a bit more fun. We're going to be looking at the budget for your business and how you're looking at their performance. Cool. Okay. So budgeting. It is overwhelming. It does feel like guesswork, and it really is. It's educated guesses, basically. You work with the information that you have to put together the numbers. They're not going to be 100% accurate. They never will. But part of the budgeting exercise is to go back and compare, what did I set as my budget for last month? How did I actually perform, and why that difference occurred? It'll help you to it'll help you to identify benefits, as well as um, items of concern that you might need to look at, certain parts where you're spending more cash than expected. You do a reality check on what's called the educated guesses, but it will never match. So don't worry about that. You just have to be able to explain the basis for your budget. If you've made assumptions about, how many customers are you going to get, um, and you should be able to explain, if you say I'm going to get 10 customers next year, why you think it's going to be 10 customers, why is that the best educated guess? And that you can also do what's called sensitivity analysis to say, okay, what if that's only 5 customers, or what if it's 15? And that's how you manage the fact that it is guesswork. So essentially, the point of the process of budgeting is to show yourself, as well as to show any potential investors, any stakeholders, that the value proposition you're bringing to the table has the potential to perform well financially. It has the potential to give you a good return. Okay, so this is a template of the budget. It looks very similar to the income statement. It's just some of the cost categorizations are a little bit different when you look at it from a budgeting perspective. And I will walk you through that. Sorry. Has anybody tried preparing a budget for their venture so far, or something you've thought about? Anyone?
So what was the question again?
Is budgeting something that you've thought about for your business in terms of how much it's going to cost or what funds it can generate?
Has anyone started thinking about that stuff?
I mean, it's kind of on like everyone's mind a little bit, I guess. But in terms of our project, I guess like we've like talked about it, but we were at least I was definitely like waiting for more like concrete fundamentals for what we actually wanted the game to be, and what like our project was actually going to do, before we could think about like possibly monetize. Well, how we would monetize it. We know we would want to monetize it. We want to make money off of our project, of course, but yeah. So yes, it's been in our minds, but we haven't really even considered it yet, because we just aren't that far.
Okay. So definitely we can walk you through the concepts, and this is the template that you would be looking at to build up your first draft of the budget. So I'll walk you through the different components to that. It is organized, so the numbers kind of tell you the flow through of how everything is connected, cascading down. Of course, at the top, you start with revenue. So revenue is how many units you expect to sell times the price per unit. And that is sorry. The number of units you expect to sell times the price per unit. And that is something that you can play around with. If you have multiple types of products, multiple price points, you can list them. You would list them separately, each category, how much you expect to generate revenue off of each one. And you can play around with that. The other thing you're going to calculate is what's called variable cost per unit. So those are costs that, sorry, I'm just going to check the chat. That's a good question. So how would the template check if you provide services instead of a physical product? The template would look very similar. It's just by the nature of providing services, you likely would not have very much variable costs. You would have fixed costs because you would be, if you have, let's say, full-time staff, you're paying them salaries regularly. That does not depend on whether you have revenue or not. If you pay them per contract, let's say if you use subcontractors, then you would still have that variable cost. So in that way, it wouldn't look very different. So I can give an example from one, I guess, sample product and one sample service, just to give you a bit more of a perspective. So let's say if you're making a toy car, your sales revenue would be 1 unit of that toy car being sold. And then your variable costs would be the material that's going into it. So, maybe the glue to hold it together, the wood that makes up the different components, the wheels, screws, to put that together. So that would be your variable cost. For both services and products, if you have, let's say you have 10 full-time staff, they're on salary, they're consistently producing those cars. That's not a variable cost, because if tomorrow you stop getting orders, you still have to pay them. Or if your order number decreases, 1 month you get 1,000, 1 month it's 900, you still have to pay them their full-time salary. So that's not a variable cost. If, for example, in a service, if you use subcontractors, so every time, let's say you have 3 clients this month and you're earning $20,000 in revenue, you pay them by the number of hours. Those number of hours would be your variable cost, because if you didn't have that $20,000 in revenue coming in, you wouldn't be recruiting them to put in the hours, and you wouldn't have that cost. But if your service is provided by full-time staff, then that would not be variable cost. You would reflect that here in what's called fixed cost of production, that you're paying them no matter what. Generally, for services for companies starting out, they use the subcontractor model, and same with let's say if you're producing a product, one of the things you're going to be looking at is accepting higher variable costs versus fixed costs. What that means is you might be renting equipment instead of buying it. Sorry, no, that's not a good example. You might have a contract to do raw materials with a supplier. Let's say, you buy for the toy car, you buy a certain amount of the wood that's going into it. If you have a contract with your supplier to buy enough for 100 units per month, then that's a fixed cost. If you tell them, I'll only order when I get orders, that would be your variable cost. So sales revenue minus variable costs give you what's called your contribution margin. And you would always be looking for that. That really has to be positive, because for every dollar of revenue that you get, if you're paying more than $1 to be able to generate that, then you're not going to make any money right off the bat. It's not going to help you cover all your your fixed costs of operating. But definitely that has to be positive. There are some cases in which your variable costs, you can strategically choose for them to be higher than your revenue. The one example of that is if you're bringing in customers to then cross-sell them something that has a much higher contribution margin for you. If you're planning on doing that, that's a strategy. For example, grocery stores will sell something really, really cheap. They will sell something below the cost it takes them to buy it, but they know people are coming in. They're probably going to buy 10 more things that help them more than cover and make a profit on the one item for sale. Okay, so sales revenue minus variable cost minus fixed costs. So big example of fixed costs is if you have full-time staff on salary, then if you're paying rent for a facility, if you have a commitment to pay, um, um, a production facility, you're using an office space or a lab, let's say you're paying $1,000 a month, that doesn't change no matter what your revenue and your production is. So that would be a fixed cost of production. When you subtract out your fixed cost of production, that's when you get gross profit. And this gross profit line here is very similar to what we looked at on the income statement, which was your revenue minus direct costs. And then after direct costs, what you have is general and administrative costs. So that's your accounting fees, legal fees, registering the business. If you, meals and entertainment, if you're meeting up with people to talk to investors, if you're talking to suppliers, if you get a loan and interest payments, that would be down here. Again, that's financing cash flows. So let me think other examples of general admin. If you have an office space, if you're getting office supplies, to manage anything, that would all go under general and admin. And that gives you your cash flow from operations. So this is pretty much cash flow from operations is very similar to where we looked at your cash flow statement. It's just we've categorized the operating cash flows in a way that provides more valuable information to you to be able to make business decisions. And then the bottom section of your budget looks very similar. So you have capital expenditures or investing cash flows. So, are you buying any assets? Are you, as a startup, you're going to also have costs in research and product development. That would be something that you put under capital expenditures or investment, because it's not a regular cost of doing business, and it's an investment in the future potential of your business. And that gives you what's called free cash flow. And after that, you can deduct the cost of financing. So similarly, it's interest, dividends. Did you get a loan? Are you paying back a loan? And that would be all shown here at the bottom. And when you fill out this statement, it's basically going to give you your period over period information about how much money you need to put into the business. Are you going to be okay in terms of funding the building up of the business? It also gives you information that you can show your investors. And then one of the key items that your investors might ask you is called EBITDA. So that's called earnings before interest, depreciation and taxes. And that would be here, cash flow from operations. That's a key number that they're going to be looking at. And they're going to want to see that is significantly improving over time, meaning that any money that you're borrowing from the investors is creating significant value in ramping up your business. So a few things I wanted to point out when you look at costs. Sunk costs, that means that there's things that you're probably already paying for that you filter into the business. So for example, if you have a home office, you've just kind of reallocated one of the rooms in your home space to take care of your business, you don't have to put that into your budget. Let's say if you're submitting it to an investor, it's a personal cost you're accepting. It's not actually increasing your cash flow, so you can leave that out. But for tax purposes, you get a benefit from all that personal, any personal assets. So home space, cell phone, internet, all of that stuff that you're using. You can have the benefit of that even though you're not specifically purchasing that stuff for business use. And you might choose to exclude that from your budget to give you a realistic perspective of, what am I actually spending extra money on? And that's fine. What you file to the CRA versus the budget you prepare and the financial statements you show to your stakeholders or investors, they can be different. And that's not a problem. You can explain those differences based on the use. Cash versus non-cash costs. One, this means that there might be timing issues. So again, if you buy something from a vendor today, but you're not paying them 30 days out, your non-cash obligation, the fact that you promised to pay them comes today, but your actual cash flow to pay your vendor doesn't come until next month. So that considering that timing is very important. Another non-cash cost is depreciation. So if you purchase an asset today, that's $10,000 out of your pocket today, let's say, and that would be shown in your budget, but in your income statement, that's going to be expensed over time and not as $10,000 lump sum today. You would see, if it's lasting 5 years, you would see $2,000 a year coming out of your income statement, and that's something you don't put that in your budget. In your budget, you show it when you're paying for the asset, that lump sum upfront, which would go under asset purchases here. Direct versus indirect costs. So we talked about that. Direct costs are what enable you to produce your products and services, and indirect costs don't play a role in the production or in your ability to be able to deliver services, but they are essential costs that you need to be doing business. Variable versus fixed costs. So direct costs can be both variable or fixed. Again, variable means for every additional unit of like the unit might be service hours, or unit might be, one more toy car sold. If you sell one more unit, you incur more costs to generate that unit. That's what variable costs mean. And fixed cost means that your costs are preset and they don't increase. If you sell more, they won't go up. Your rent for your facility is what it is. Fixed costs get you to a certain capacity. So let's say they enable you to produce, fixed costs let you produce, 1,000 units per month, or they let you serve 10 clients if you're a service producer. And if it's more than that, then you would need to invest more in fixed costs. So you would need to rent a bigger facility. So fixed costs are not set in stone forever. It's just, so if you're looking at a graph, variable costs increase for every additional unit of sale. So if you're looking at plotting variable costs and units sold, you're looking at the graph going up straight. But with fixed costs, it would jump up in increments. So every time you need to increase the capacity more, it jumps up. But within that capacity that you've arranged for your business, fixed costs just stay at the level that you're currently paying for them at. And the other type of cost is personal versus business costs. You'll pay some stuff out of pocket, you'll reallocate personal assets. When I started my business, the computer that I had personal, I reallocated that. I use that for the business. You don't have to show your investors that. Definitely consider all your personal costs that you've reallocated to your business when it comes to CRA, because you're going to get the benefit of that. It's going to lower your taxes. But I would take the liberty, you can not include them when you're showing your investors that, I need money for a laptop, or, I'm paying rent, because you're using your home office. And that also shows that, you're putting in your own value into the business. You're investing your time, your personal assets into creating it. Also be mindful of what you're spending on that certain personal costs, whether they can legitimately be put into your business or not. And that it's a matter of how you explain it. So let's say, you go out for dinner. If you're meeting with if you're meeting with a friend who can, advise you on the business, who's going to help you to talk about the product design, it is a business cost. If you just take your family out for dinner, that is personal. So there can be little things that differentiate between what gets allocated as a personal cost versus business cost. And it can also be a percentage. So if you have a cell phone and you use that same cell phone number for personal and business, you can say, well, I use it for business 25% of the time. Well, 25% of it, you can fix 25% of your bill, you can put towards the business. So that is just some general feedback in terms of things to consider when compiling the budget and how to look at the template. Do you guys have any questions? Are there costs that you're not sure about for your own business where they belong? Okay, I will walk you guys through that a bit more. So one of the activities I like to have businesses consider is translating what you're trying to do within your business over into a budget. So looking at your strategic objectives, setting specific goals around that, and asking yourself, what are the critical activities and resources you need to be able to reach that benchmark, to reach that goal, and then putting a dollar amount on those activities and resources. So you will notice, if you guys have worked with the business model canvas, these are all concepts that are tying into the business model canvas. Your strategic objectives are going to be around your value proposition. They're going to be, if you want to build your resources and activities, that can be a strategic objective. Getting more customers, that can be a strategic objective. And then, sorry, setting specific targets around that would be, assigning a number to a 10. I want 10 new customers. I want to get a better supplier who has, the right input for the product that I'm trying to produce. And then your critical activities and resources would be things like, if you need to hire a person, if you need to, you say, I want to incorporate, I need to get a lawyer. So that would be your key resource. Key resource would be to find a lawyer. If you're trying to get an IP for your business and that's your strategic objective, your goal is going to be to, do the research and development, get that product ready and tested into a state that you can then get the IP for. Your critical activities and resources are going to be dedicating the time and the right expertise into conducting that research development, whether that's you or you hire a scientist, or you have to buy some raw materials to do the testing on. That would be your critical activities and resources. And then out of that, you would get your budget. So your budget would be, are you paying that person? Are you paying yourself with the time you're dedicating to research and development activities? What are the materials that you need to test on to build a prototype? What is the equipment you need to be able to build that prototype? And then you would say, can I if I just need to do a couple of tests, can I just go and rent it from somebody? Can I just get somebody to give me that for free? And I always encourage people to document that stuff as well. If you have critical activities and resources that you need, and that are going to be part of your business in the long term, that you document that and you indicate for yourself, it's $0. It's free for me as a startup because, for example, I get access from the incubator to Amazon Web Services. If that's something you're going to need in the long term, it's a critical resource. Document that in your plan and note it down that it's free for now and why, and how much you expect to pay for that later on. But that's always possible that your budget in the end might come to zero, because as a startup, you can access those facilities. So I'm going to be doing a bit of an example of this exercise with you guys. Have you guys had a chance to prepare your business model canvas?
They have, yes.
Okay. So I like using this as a structure to start thinking about your costs. And what I've done here is in each of the sections, put in some questions that will help you think about and document what those costs are going to look like. So I can walk through it section by section. So under value proposition, you have to consider what is required for you to be able to deliver on that. And again, your direct costs would be ones that help you to create and deliver on that value proposition. And indirect costs would be ones that are not specifically related to that value proposition and product and service. On the right, no, sorry, on the left side, you see the activities and resources that are going to go into creating your business. They're going to go into creating your products and services. So the left side is going to give you all your variable costs of production. They're going to give you fixed costs of production. You're going to have some general and admin under your key activities and key resources. So those are all the costs of production, costs of operation that are going to be feeding into your business. Your key partners could be in the way of employees, maybe they're subcontractors, maybe they're providing you with financing. So defining what bucket that key partner falls into. Maybe it's financing, cash flow, maybe it's payroll. Is it fixed? Is it general and admin? And that would be assigning the right context to your key partner depending on what they're providing for you. And then on the right side are costs for sales. So when it comes to customer relationships, you're going to have both some fixed costs and some variable costs, but generally there will be direct costs related to providing your product or service to build that relationship. So do you have a sales team? Are you providing after sales customer support? How are you getting the product to your customer? How are you making sure it meets their needs? All of that is going to go into your direct costs. And same with the channels. So if there's any, let's say maybe you pay someone a referral fee as a channel if they recommend a customer to you, that would be a variable direct cost of doing business. What does it take for you to get your product to a customer? Are you paying a retailer a margin? Are you, maybe you have a Shopify store. Shopify store would be a great example of a fixed direct cost. I think there's a fixed component and a variable component. So you have, I think it's like $10 a month. That's your fixed direct cost of having a channel. And then you have a variable component to it that you pay Shopify a fee. I think it's like 3% every time you make a sale, you pay that to them. So that would be something to consider in channels. And then you have customer segments. This is what's going to give you information about what your revenue structure is going to look like. So what is your one unit of sale that you're selling to your customer? Are there different types of products or services that you're selling? Then you would have different units and different price points listed on your one budget, separate sections for different products. Also think about your pricing strategy. So is it a one-time purchase or are people subscribing over time? And if they're subscribing over time, in the unit of sales, you would think about, how often does a person purchase? Are they coming on for quarterly? Do they renew annually? Which looks very good if you're building long-term relationship with your customers. The thinking about the nature of that revenue, long-term, short-term, are they renting something from you? And then the last thing to consider under customer segments is the cost to access them. So are you doing any marketing? And marketing and are you doing any advertising? What are you spending on social media? And that would go into, if you're doing strategic marketing, that's more like a general and admin cost. And then if you're paying for any advertising, that would be a direct cost. Are there any questions about this process? Like if you look at your own business model canvas, is there something that you're not sure about how to take those notes and translate that into a cost and where that would go in the budget? I'm happy to walk through some examples and that might help everyone. Any volunteers?
I can ask a question. For the key resources, so for example, some of my resources are programs, so like Photoshop and like Premiere Pro, Canva, stuff like that, or like paid promotions on Instagram. Would that all go under key resources?
Yeah, those are key resources that you need. And then the costs. So for example, Canva, you pay an annual subscription. The cost associated with that would be a fixed cost of production.
Okay.
Is that something you need to actually produce your product, or is it for advertising?
It'd be for production. It's one of the tools I've been trying to use.
Okay, so that would go under your fixed cost of production, and that's because whether you produce 1 unit or 10 units, Canva's not going to charge you anymore. I think it's like what, $180 a year or something like that. You would put that under fixed costs for production, and yes, under key resource.
And for example, because this I don't sell a product, I sell services. So would that be going under like this time that I spend doing the project, doing the assignments, whether they're just as need or in long term, would that all go under customer relations as well?
Your time spent.
Yeah.
Mhm.
So like essentially the labor put into it.
Yeah, so you would be, whatever work you're doing, I would expect to see that under one key activities. So whatever you're using Canva for to create that product or service, it would be under key activities. And then as the founder, you're also going to be doing marketing. So let's say, I think you mentioned like Instagram ads. If you're spending time promoting to your customer, that would be under customer relationships. So
Okay.
yeah, the work you're going to be doing, depending on what it is, will fall into multiple buckets, and
Yeah.
that's expected for a founder.
Oh, okay, cool. Thank you.
Any other examples? No? Okay. Yeah, if anyone has questions related to their specific business model canvas, I'm happy to help you tackle that afterwards. But basically there's a lot of information here that can really help you to put together your budget and to fill in revenue and costs. Left side, all your costs of production. Right side, the cost of sales, marketing, accessing your customers, how you're delivering to them. It's all here, and then your revenue structure would come out of the right side as well. Okay, so looking at the budget, and once you filled it in, what kind of information can you get out of it? One of the things is what's called the break-even point. So what the break-even point means is how many, or the question it answers is how many units do you have to sell to be able to make a profit and cover your fixed costs. So your fixed costs are not changing; they're static. If you're paying, let's say you're paying rent for $1,000 for your facility to produce, and then your price per unit, let's say, is $8 a unit, and your cost per unit. In the example of a toy car, you sell the toy car for $8. Your cost per unit, glue, wood, screws, a few hours of labor. Let's say your cost per unit is $3. So what you would do is for every unit that you sell, I'm just going to pull up a calculator. Just to put it very simply, your price per unit is $8. Your cost per unit, I said, is $3. So every time you sell a unit, you're bringing in an additional $5 into the company. And that $5 is going to help you cover your fixed cost of production, your general and admin costs, everything that you're paying out of pocket, no matter what. So if that is, just to keep it simple, if you're paying $1,000 every month, no matter what, that's your fixed cost. If you divide that by 5, that's 200. So this tells you that you have to sell 200 units to break even and then start making a profit. If you're selling less than $200, you're operating at a loss. And after $200, so when you sell your 201st unit, that $5 is profit. And this is an important number for you to know. One, to know that you're not investing too much in your fixed costs that you're just not going to be able to recover. The other thing to think about is, can I realistically sell $200? So if you do your customer study and you realize that your market potential is going to be that, it's 50 customers, and maybe it's not more than that. I mean, these are very simple numbers. You would be looking at larger numbers. If your potential is only 50 customers and that's all the market it has, then it might not be the best. It might not be the best approach for you to just have this one product and invest that much into that market. You would have to go back and maybe rethink. Maybe you need to increase your price. If you increase your price from $8 to $10, then you are putting $7 into margin every time. That would lower your break-even point. You would have to sell fewer units to make a profit. Can you lower your cost? Can you avoid some of the fixed costs? Maybe, you don't do $1,000. Maybe you only do, maybe you rent a smaller facility that can produce less because you don't need the capacity. So those are questions you can ask yourself to see, is the break-even point reasonable? Can I reach that point? If not, can I lower the break-even point by increasing the price or lowering the costs? And the break-even point is something that investors will look at for early stage businesses. Within the first couple of years, you might not reach your break-even point. One, because your costs, some of your fixed costs and invested costs that you put in, for example, for research and development, are going to be very high. But you're investing in the long-term potential of your business, so it's not required for you to break even. But if 2 years down the road, 3 years, 4 years, you're not showing that potential to break even, then there's a problem. So you want to assess now if, let's say you build out your budget. I would say build it out for like 4 or 5 years. In that 4th or 5th year, I would really be looking to pass that break-even point for sure. So that's one. And next thing is sensitivity analysis. Of course, with a business, not everything is in your control. So how your customers behave, the state of the economy, how much your customers are willing to pay. So those are items that are not really in your control. What you do for that is, let's say for an investor or stakeholder that wants to see your budget, they might ask you, why did you set your price to $10, or why 200 customers? So you can say that that is your best guess and why. Going back to the earlier slides, that budgeting is educated guesswork. You can explain to them why you think you can get 200 customers, but sensitivity analysis would be an exercise where you show them, what does the budget look like if I only sell 100 units, or what does the budget look like if I sell 300 units? You can see what that reasonable percentage is depending on the risk level. Maybe you say, what happens if revenue is 10% less? What happens if revenue is 15% less? And you don't have to have a full budget file for each scenario. You prepare the budget based on your best guess, or your what's called your base case, and then you can prepare a best case scenario, worst case scenario, give them a few other alternatives, and then You would just say, if my sales are 15% less, my revenue would drop to X number. If my sales are 15% less, my profit drops to, and if you report those key numbers for a few points, so let's say you give them 4 different scenarios with sensitivity analysis, and it'll provide them insight into what can happen within the business, and it'll give them the indication that you've thought about, I'm going to sell 200 units, but what if it doesn't work out? What's your plan then? That you've thought about, if the business performs at a little bit less, you can survive. If the business performs better, that you actually have the capacity to manage that as well. Cash burn rate. This is the other very important thing that you're going to be looking at with your business budget, and that's more for your internal use. How long will your money last? So me, for example, for the business that I run, I update the cash tracker on a weekly basis and compare that to the budget to say, am I going to run out of money? One example was, so I'm getting a payroll subsidy this summer. I'm paying the students every month, but I don't get the money back until September. So that really took a big hit on my cash burn rate. And it was showing me, I'm hitting negative at the end of May, which I did. So I had to look at that cash burn rate and say, I need to find another way to put money into that, because for the next couple of months, my cash burn rate is a lot more than the money I have sitting there. And this would be something that would trigger, I need to put more money in. I need to bootstrap. I need to maybe, do some fundraising with family and friends. You need to apply for a bank loan, get an operating line of credit. How can you match that cash burn rate that you have to spend at by bringing enough money into the company? And how does that look like long term? For this, I would say you would need to have a budget that's tracking things on a monthly basis almost, so you know what's going on and when you need to bring in your money. Different versions of the budget and strategies for different users. So what this basically means is, if you're going to the bank and asking them for a loan, you're going to be showing them a budget of what things are going to look like if they put that money in. You can show them, if they're putting in 100,000, you're going to invest that on some key equipment. Show them a budget that's showing that 100,000 coming in and how that $100,000 is making a difference. And then for a comparative, you can show them a version of what you might have to do if you don't have that $100,000 coming in. So a lot of the entrepreneurs that I work with, they're talking to multiple investors at any given time, and one investor has 100,000 on the table, and the other investor has different priorities, and only $80,000 on a table. So you're going to be giving them different versions of your budget based on the terms that they're willing to offer you, based on their interests in the business, and that's totally fine. To have those different versions of the budget, with assumptions about what your investor is looking for, what do they want to see happening in the business, and how much money they would put in, what that would enable you to do. And that's fine. You will have many different versions of the budget running. If you're getting a grant, you're going to be preparing different versions for a grant, and submit that, and that might only come to reality if you get the grant, and you might not end up doing any of those expenses or even following that version of the budget if you don't get the grant. And that's fine. You will find yourself preparing a lot of different versions of the budget for different users and what they would be providing you funds for. The other thing to consider in budgeting is to report by segments. What that means is, if you're providing different services, or you're providing different products. For example, I work with a business. So one thing they do is they're doing the research and development into a product, and they are planning on selling that product. But what they're also doing is providing some consultation services, because they're experts in technology. Um, and you can report those as separate segments, because it lets you track what particular aspect of your value proposition and bringing in the most value. So it would be very important for me to show the revenue and the variable costs and fixed costs separately for the consulting piece versus the product sales piece. If you're providing services, for me, for example, I do work in I do work in accounting, taxes. I do work in also creating other resources. I work with social enterprises. So those are key segments. I provide different kinds of services, and I track them separately to see, how they're doing, which services are more in demand, which services have a higher profit margin. And that lets you make important decision in terms of what you want to focus on in the long term. Yep. And then lastly, the budget will also help you make decisions about pricing for your product. So if you're throwing in all your information in terms of the variable costs, so the raw materials, the time, the labor it takes to produce your toy car, or the number of man hours needed, the number of hours needed to be able to deliver the service that a customer has purchased from you. When you have all that information documented and you assign a dollar value to it, then you can decide what is the price you want to charge your customer. And then based on your customer interviews, you can say, will my customer actually pay that? If not, then the budget can become a reiterative exercise where you can say, well, maybe I need to lower one of the costs, or this isn't the right service for me to provide. Maybe I can bundle the services, and you can play around with your pricing model based on the information that comes out of the budget. Another big example of a decision it can help you to make is whether you buy or rent. So if you're using equipment or you're using a facility, do you want to purchase and own that, or do you just want to rent it? There would be the example of the equipment. You can pay $10,000 today, or you can pay $2,000 over time to rent it. And at some point, renting might get more expensive for you. So you can look at that if you have the money, or you're looking for an investor to buy that asset. It can create more value for you. Generally, buying is cheaper than renting it in the long term, but you have to have the money up front to buy that, and you can kind of play around with that priority of doing something in-house or not. Yeah, so those are the kind of decisions that a budget can help you to make. Prepare a budget, play around with it, think about different aspects of your business model, canvas how you're changing it, and reflect that in the budget and the numbers that are coming through. You can amend the price. You can go back and say, you need to find cheaper sources for materials. Then you update your variable cost. Yeah, it's like a sketch. You can keep improving, making different versions of it to give you the information you need on how the business is going to perform. Any questions? Okay. So I've been talking a lot about investors and funders. I just wanted to go through the different ones that you might be looking at, and the nature of their relationship with you. So first is debt or bank loan. You will get money up front, and that money has to be repaid, and there's interest attached to it at a prescribed rate. And you might be paying that principal back in increments over time, or you might be paying lump sum at the end. But the interest payments at the prescribed rate are an obligation that you would have to pay for every period. And then you have equity. So when you issue equity, the investor would actually own a portion of your business, and that's determined by the number of shares they own. it's more risky than debt because it's not they don't have a promised return. So if debt, you say, if let's say you get debt from a bank, they'll say you have to pay 6% per year. With equity, there's no such guarantee, and they get value in two ways. So one, let's say they invest $10,000 in your company today, and you do really, really well. Your product sales perform really well. Your sales grow. Your customer base grows. That equity is automatically going to increase in value. So if 4 years down the road they decide they want to sell their equity portion, for that $10,000 today, they might be getting $50,000 in a couple of years if the value of your business jumps up that much. The other way they get value is through dividends. And dividends is something that established companies do. It's not the norm for startup or growing businesses. And it's not required to do dividends, but what you can basically do is you just issue a notice to the equity holders saying, we're going to pay you 10 cents for every share that you own. And when you declare that, you would just issue them that payment, and that would come out of the profits that the business has, or if you have extra cash sitting around, which is not the norm for growing businesses. Then you can also have a joint venture, which means that you can have multiple companies working on the same project, and it would be negotiated in terms of what percentage of the costs are being supported by one person or the other, what are the resources being contributed, and how are the profits from that project going to be allocated to the different companies that are involved in that project. The last two examples are grants and subsidies. They are both non-repayable. Their obligation would be, so if you get project-based grants, they would want you to report back that you've accomplished the project. They would want you to show your receipts that you spent money on whatever you were going to spend it on. Grants can sometimes be paid upfront, and they let you spend over time. Subsidies are, again, non-repayable, very similar to grants, but subsidies are generally not project focused, they're more expense focused. The best example of that is a payroll subsidy, so something like the Canada Summer Jobs Grant. The Canada Summer Job is really a subsidy that you pay employees, and then they pay you back, and you're not required to repay them, but you submit proof that you've paid employees, you've paid the approved expense, and then they give you the money to cover that. So these are the big key types of stakeholders that are going to be looking for information coming out of your finance and accounting system. They're going to be looking at your, some of them more than others, they're going to be looking at your budget to see what your company's doing, what kind of projects you're up to, and that you would be looking to prepare information for, other than, of course, preparing it for your own strategic planning. I have a few notes here in terms of considerations when you're raising money, the pros and cons when it comes to debt, equity, and grants. Debt has a prescribed rate attached to it. Equity, the shareholder adopts a bit more of the risk. But with equity, there's a little bit of risk that, if they want to be involved in the business because they put in equity, they can intervene in your decisions. They can be more involved. So sometimes founders do lose control. With debt, you have to come up with a cash flow to be able to pay. It's easier to get sometimes small lines of credit and loans versus raising equity or getting a large loan. Another benefit is interest. Anything you pay in interest is tax deductible. Debt is also generally cheaper than equity. It's easier because it's so clear that you're paying, X percent interest, whereas with equity, they buy a portion of your business, and if they choose to sell it or they want a return on it, it is quite a bit more complicated. And then for equity, you have to be incorporated. For debt, you can be a sole proprietorship as well. And then lastly, with grants, of course, it's great that it's non-repayable, or if you get interest-free loans, it's definitely cheaper. There's just a lot more administrative requirements that you have to report back to them exactly what you spent money on, spending the receipts and all of that. It's a lot of work. But I mean, grants always help to get businesses started without the pressure of having to repay money quickly. Yeah, I'm not going to read through all of them, but those are there. If you have them in the slides, those are the key differences. More details on the accounting process, exactly what happens, how you get from the activities happening within your business to the financial statements, and the users. This is something that's going to be covered in the Finance Foundations course, which is taking place on June 23rd. And I'm told that you guys will all be there. It's a fun session. Yeah, so that'll give you more detail on the day-to-day aspect that's involved in compiling the statements, how you go through the process of creating some of the information needed. More detail. Today was more strategic, I guess a little bit more intense. But this will be good to fill in some of the gaps in what we've covered today. That's about it from my side. Does anybody have any questions? A lot of information.
I have a question.
Yeah.
When you're calculating for, say, employee like salaries or like wages, I'm assuming those would have to be deducted from your total income, or like I guess monthly report of whatever income you had reported already. So like, say if you made $1,000. I mean, I'm just giving an example now, like not that you do that you would do, but like you say if you just made $1,000, but you need to pay employees like 50% of that, for example. Would that be calculated in the initial report where you were to calculate expenses for the company, or would it be like something completely different? I noticed that it wasn't on some of the slides about that.
Yeah.
But I could be wrong.
Payroll, depending on the nature of what the person is doing to earn that pay, it could be cost of production. So if you have somebody who is helping you to deliver the services directly or helping you to create that product, that would go under your variable or fixed direct costs. And if it's a person that's helping you, if you have a social media or marketing person, if you have an accountant, or if you have management. So let's say yourself, the time you're spending just managing the company, that would go under general administration. So payroll is definitely a key cost in those categories. Let me just go back. Nope, sorry, too far. There we go. So payroll, if I think you mentioned you're paying 50% of that. If your payroll is determined by how much money you make, then it would go under variable costs. If it's prescribed already that you're going to pay them $500 no matter what, then it would go under fixed costs.
Okay. So I guess if you were making a product that would it had variable costs or unpredictable costs, it would go under that, I'm assuming. It'd just be a percentage of the total income of the month or
yeah. So with something like payroll, it really depends on the nature of the negotiation that you've done with the employee. If you tell them, I'm hiring you full time,
right,
you're going to get paid this amount every month no matter what, that's a fixed cost. If you tell the employee, you're doing the work, but you're going to get paid on you're going to get paid on commission, then that would be a variable cost. If you tell them, I'm going to bring you in, if I sell the units and you have to make them, then I'll bring you in for those hours, submit a timesheet, tell me how many hours you've put in, and I'll pay you for those hours. That's a variable cost.
Okay.
Yeah. So it really depends on what terms you've negotiated with the employee, or employee or subcontractor, that you would allocate it between those different categories.
Okay. All right, Andrew, Dom, you heard that? 10%, both of you, 10%. I get 80%. You get 10%.
Yeah. So because it's a percentage, that would be a variable cost.
Yeah. Okay. Because like because I've been thinking about it like because we're making a game, and so our costs would be. I mean, obviously, it'd be very random. Like we don't know how good or how bad it's gonna be. All we can do is like account for like how good or bad it's going to be. So I was wondering how to do that in terms of income after everything had already been set, because we have to apply for we have to buy like certain programs, and then we have to go into uh not like a third party distributor, but like a online distributor, and then go on from
You have a lot of fixed costs where you have to buy the program upfront and get it ready, and then people can subscribe to the game, but you have to have the game ready.
Also, another question is that when you're compiling your budget, are you doing this like monthly, or because like I'm wondering, because like if you are doing it monthly, then what if you had just finished your budget report and then you bought something the next day? Would that go into the next budget report, or would it go into like a thing that you keep track of like everything, so it's updated automatically?
Okay. So your budget report, I believe the template that you guys will receive, you have months going across. So let's say you have a column. This column, you would make one for each month, and this is just for internal tracking. So you run January to December. If that purchase was a part of your budget, then it would be in line with that. Hopefully you put it into the budget, but it's possible that you end up making some purchases that were not on the budget. Every time a month ends, you can take that column of the budgeted or the predicted amounts and replace that with the actuals. So you always have a tracker of what's really happening. So let's say, May 31st, the month just ended. On June 1st, yesterday, I sat down, I collected all my receipts, and I updated this column for what actually happened. And I replaced the budget, and it tells me a picture of, for example, there was something I was planning on buying in June, but I bought it in May. So that was reflected in the May column now. So then I reviewed my budget for June, and I said, well, I already bought that. It's reflected. So I updated my budget for June by removing that. But it's a helpful exercise to review your budget versus actual month by month.
Right.
So if you've made your budget out for the full year, keep that. At the end of every month, do a comparison on what you actually spend, what your actual bank balance is, and say, why did the differences occur? Maybe it's because things are happening faster and you need to spend more money. Maybe you've decided that some of the expenditures could wait. Or you changed maybe your research and development process changed so that you don't need certain equipment anymore. So it's always important to ask what I would go and replace and do a comparison.
Does Zahra just disconnect for anyone? Or is it just me?
I think she's frozen. Zahra, can you hear her?
I think I lost connection there for a minute.
You're back. You're back. Can you hear me?
Okay.
I think we lost her again. She's in and out.
Can you hear me?
We can now, but you keep disappearing. Maybe turn your camera off if it's not off already, because you're frozen.
Yes. It's in and out.
fully lost her. I mean, we're done anyways. Let's just give it a
Fine. I had one more question, but I guess I can.
Yeah, let's see if she comes back. You guys are gonna see her again in later in June, as she mentioned, for the next phase of this kind of stuff.
Okay, that's completely fine. Honestly, I think I might be in the same boat as everyone else. I think there's a lot of questions honestly, because I feel like she was like kind of throwing phrases out, and I was like Googling stuff at the same time while she was throwing phrases out.
You guys should have stopped her. She gave you that option. Why didn't you stop her?
Oh no, that's what I was asking. That's why I'm just asking all my questions at the end because I didn't want to keep the meeting too
Okay.
long. Yeah. Man.
Hi. Sorry about that.
No worries. And do you want to ask your whatever question you had?
Yeah, for the cost that what was it? Which cost was it? I actually forgot what my question was.
Okay.
That's
I
okay.
actually forgot what my question was.
You could always ask any questions you have from this session as well as next session in the next session on June 23rd if you're all going to be there. So feel free to do that.
Yeah, for sure. Okay.
Yeah, Andy was mentioning when we lost you, it's a lot of new things. So there has been a lot of Googling happening in the back end. So if you guys take kind of what you learned from today and start working on it in bits and pieces, and then you'll have access to Zahra again on June 23rd. So you can be prepared with questions. Okay, so if there are no additional burning questions, we'll wrap it up. It's already 12:04. Thank you so much, Zahra, for joining us today. And I'm glad the technical difficulties waited to the very end. At least we got through on a good technical note. So thanks again. Good to see you, and we'll see you again in 3 weeks or so.
Yeah, thank you. Good luck, everyone.
Thank you. Take care.
Bye.
Bye. Okay, so Toma, if you can stop recording if you haven't already. Yeah, you haven't. If you can stop recording, please. Okay, so we will break for lunch, and we'll maybe you guys can come back for like 12:40 for the next section of the day. Okay, so we'll see you at 12:40. Toma, it's still recording.